Welcome back, Boss Economics World fans, your one-stop shop for exposing the economic clown show that is modern governance. I'm your host, the guy who's been yelling into the void about government mismanagement since inflation was just a twinkle in Jerome Powell's eye. Today, we've got a story so juicy, it's practically a prime rib of economic dysfunction. Grab your popcorn, or your pitchforks, because we're diving headfirst into the latest Fed drama, Trump's tantrums, and the looming recession that our so-called leaders are sleepwalking us into. Let's break it down, from the surface-level shenanigans to the deep, dark economic rot underneath. Buckle up, folks, this is gonna get spicy. Let's start with the juicy headlines, shall we? Interest rate traders, those vultures of the financial world, are licking their chops, betting on a seismic shift in U.S. monetary policy. Why? Because President Donald Trump, in all his infinite wisdom, is gearing up to replace Federal Reserve Chair Jerome Powell when his term ends in May 2026. And traders, bless their greedy little hearts, are already positioning themselves to cash in on the chaos. How do we know this? Just look at the Secured Overnight Financing Rate, SOFR, futures market, a crystal ball for predicting Fed policy moves. This week, June 9th to 15th 2025, traders were in a frenzy, selling the March 2026 contract and buying up the June 2026 contract like it's Black Friday at the central bank. What does this mean? They're betting the Fed will slash interest rates sometime between those dates. And not just a little trim, oh no, they're expecting a full-on monetary haircut, courtesy of Trump's hand-picked Fed chair. On Thursday, June 12, 2025, trading volume in the spread between these contracts hit a whopping 60,000, the second highest on record, only topped by April 9, 2025, when Trump's tariff pause sent markets into a tailspin. Open interest is up, too, meaning these aren't just day traders playing hot potato, these are serious players setting up camp for the long haul. Now, why are traders so confident rates will get slashed? Simple. Trump's been throwing a hissy fit about Powell's refusal to cut rates faster than you can say, quantitative easing. Just last week, June 2nd to 8th 2025, Trump was back at it, whining that Powell's term cannot come fast enough. Sure, he's promised not to fire Powell outright, how magnanimous of him, but the pressure is on. Trump's already hinted he's got a successor lined up, and you can bet your bottom dollar it'll be someone who'll bend the knee and cut rates faster than a chef at a sushi bar. Now, let's peel back the layers of this economic onion and get to the real meat of the issue. Why is Trump so obsessed with slashing rates? And why is Powell holding the line at 4.25% to 4.5%? To answer that, we need to rewind the clock and look at the Fed's recent track record, because, folks, this is where the government's fingerprints are all over the crime scene. Back in 2022 and 2023, Powell's Fed jacked up rates at a pace not seen since the 1980s, trying to tame inflation that had spiraled out of control. And let's be real, whose fault was that inflation? Oh, right, the government's. Trillions in COVID-era stimulus, courtesy of both Trump and Biden, flooded the economy with cash, while supply chains were choking on their own incompetence. The result? Inflation hit 9.1% in June 2022, the highest in 4 decades, according to the Bureau of Labor Statistics. Powell had no choice but to slam on the brakes, raising rates from near zero to over 5% in just 18 months. It was a brutal but necessary move, or so we thought. Fast forward to late 2024, and the Fed finally started cutting rates, 3 times, bringing us to the current 4.25% to 4.5% range. Why? Because inflation had cooled to 2.6% by May 2025, according to the latest consumer price index data, and the labor market was starting to wobble. Unemployment ticked up to 4.2% in May 2025, per the Bureau of Labor Statistics, and job growth slowed to a measly 120,000 jobs per month, hardly the booming economy Trump likes to crow about on Truth Social. The Fed's projections from March 2025 suggested 2 more quarter-point cuts by year-end, and economists surveyed by Bloomberg agree, predicting cuts in September and December 2025. Sounds reasonable, right? Wrong. Enter Trump, stage right, with his trademark subtlety, aka none. He's been railing against Powell since day one, claiming high rates are strangling the economy. And now, with Powell's term winding down, Trump sees his chance to install a yes man, or yes woman, who'll slash rates to juice the economy just in time for the 2026 midterms. Never mind the long-term consequences, Trump's all about the short-term optics. But here's the kicker, the Fed's next meeting is June 16 to 17, 2025, just weeks after Powell's term ends. Traders are betting Trump's new appointee will hit the ground running with a rate cut, consequences be damned. Now, let's zoom out and look at the bigger picture, because this isn't just about Trump's ego or traders' greed, this is about the government's systemic failure to manage the economy without driving it off a cliff. The Fed's tightrope walk between inflation and unemployment is a symptom of a much deeper disease, decades of fiscal irresponsibility, political meddling, and a complete lack of vision. First, let's talk about the recession risk, because, spoiler alert, it's coming, and the government's to blame. The yield curve, that trusty harbinger of doom, inverted again in April 2025, with the 10-year Treasury yield falling below the 2-year yield, according to Federal Reserve data. Historically, an inverted yield curve has preceded every U.S. recession since 1955, with a lag of about 12 to 18 months. Do the math, folks, that puts us on track for a downturn in mid-2026, right around the time Trump's new Fed chair takes the helm. Coincidence? I think not. And what's fueling this recession risk? Oh, just a little thing called government debt. As of June 2025, the U.S. national debt stands at a staggering $35.7 trillion, according to the U.S. Treasury Department, up from $31 trillion in 2022. That's over 120% of GDP, a level not seen since World War II. Interest payments on that debt are now eating up 15% of the federal budget, per the Congressional Budget Office, crowding out spending on infrastructure, education, and healthcare. And guess what? Those payments are only going up as rates stay elevated. But does the government care? Nope. Both parties keep spending like drunken sailors, passing trillion-dollar infrastructure bills and tax cuts without a shred of fiscal discipline. Meanwhile, Trump's obsession with rate cuts is pouring gasoline on the fire. Lowering rates might juice the stock market and boost GDP in the short term, but it risks reigniting inflation, especially with oil prices creeping back up. Brent crude hit $95 per barrel in May 2025, per Bloomberg data, thanks to OPEC Plus production cuts and geopolitical tensions. And don't forget the housing market, which is already on life support. Mortgage rates are hovering around 7%, according to Freddie Mac, pricing out first-time buyers and stalling construction. A premature rate cut could inflate another housing bubble, setting us up for a crash worse than 2008. Here's the real kicker, folks, the root of all this chaos is the government's insistence on meddling in monetary policy. The Fed is supposed to be independent, free from political pressure, so it can make tough decisions in the public's long-term interest. But Trump's treating it like his personal piggy bank, and Congress is complicit, refusing to rein in spending or address structural issues like entitlement reform. The result? A central bank caught between a rock and a hard place, forced to choose between short-term political demands and long-term economic stability. And let's not forget the global context. The US isn't the only country flirting with recession. Europe's already teetering on the edge, with Germany's economy shrinking by 0.3% in Q1 2025, per Eurostat. China's growth is slowing, too, with GDP projected to drop to 4.5% in 2025, according to the IMF, thanks to a real estate crisis and declining exports. A US recession would ripple across the globe, and Trump's rate cut obsession could make it worse by weakening the dollar and driving up import costs. So, what's the takeaway, boss economics world fans? The government's economic mismanagement, decades in the making, is pushing us toward a recession, and Trump's meddling in the Fed is the cherry on top. Traders are betting on chaos, and they're probably right. But here's the thing, this isn't just about numbers or charts, it's about your wallet, your job, and your future. While Washington plays political ping-pong, ordinary Americans are stuck paying the price. Want proof? Just look at consumer confidence, which tanked to a 10-month low in May 2025, according to the Conference Board, as inflation fears and job insecurity mount. Small businesses are feeling the pinch, too, with the NFIB Small Business Optimism Index dropping to 89.5 in April 2025, the lowest since 2012. And don't even get me started on the wealth gap. Since 2020, the top 1% have gained $15 trillion in wealth, while the bottom 50% have barely budged, per Federal Reserve data. This is what happens when the government prioritizes optics over substance, and Wall Street over Main Street. So, what can you do? First, educate yourself, watch channels like ours, read the data, and call out the nonsense. Second, protect your finances, diversify your investments, cut debt, and brace for impact. And third, hold your leaders accountable. Demand fiscal responsibility, defend the Fed's independence, and reject the circus of short-term gimmicks. Until next time, Boss Economics World fans, keep your eyes on the charts and your fists in the air. This is your host, signing off, because someone's gotta call out the clowns running this economic circus.